This week, Ben and I are going to discuss energy within the United States sector, looking at some export numbers coming out of the US, and then winding things down with international production. Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, as always, joined by the University of Missouri's Ben Brown. Ben, how's it going?
I'm doing well, Will. How are you today?
Doing all right. Just trying to push forward through another week. Some craziness down here in Texas on some things coming up, and so, things that just happened. Had the F1 race along with Texas versus Georgia just here recently. So a lot of craziness in Austin, but finally it's kind of
Trust me,
dissipating.
trust me. I think we all know about the Texas-Georgia football game at this point. I'm
Yeah.
gonna I'm gonna refrain from throwing a bottle at the screen. Okay, so outside of that, I do have something ag-related to share. So this weekend I went to Effingham, Illinois, and as I was driving, going 70 miles an hour down the highway.
The speed
um,
limit.
Yeah, the speed limit. Driving 70 miles down the highway, I started passing all these fields that were bright green and looked like they had just been planted. Um, and I thought to myself, I was like, this is not an area of Illinois that I normally see winter wheat production. And so I was kind of a little bit surprised. I was thinking what this could mean to the wheat market. Well, anyways, I stopped to get gas. And when I slowed down to get gas, I looked over. That wasn't wheat, that was soybeans coming up. I should have known that it wasn't wheat. It sounds crazy that an ag economist can't tell the difference between wheat and soybeans. I promise, like it was just me driving down the highway. But um,
170.
so the reason I bring this up is because, all these reports of dry soybeans, I think what, should have been somewhat a part of this conversation was the loss at the head of the combine. And it kind of makes sense. And then with the warm weather we've had here lately and some moisture, it's really popped up those soybeans. So it'll be interesting because harvest loss is not necessarily a part of the objective yield survey that is done where they go out into fields. They assume some form of loss, but if this is the year where we have higher than normal loss, that's going to start showing up in some
Shift
of
the
those
picture.
grain. Yeah, those are going to start showing up in some of those grain stocks numbers. So
Yeah. Well, just before we dive too deep into some topics here, going to give an update on prices and talk about that shifting outlook and shifting cost picture. So, Ben, looking at the change in the market of the last week, we were kind of moving higher on a lot of fronts until about Thursday or Friday, and then that shifted downward. So, looking at the update on the week, is mostly flat in a lot of areas. So, that December 24 corn contract only up 1 cent at 4.10. December of 2025, corn up 2 cents at 4.39. November 24 soybeans down 7 cents at 9.74. November 25 beans down 4 cents at 10.21. Soybean oil on a cents per pound basis for December were flat at 42.69. Soybean meal for the short ton for December down $13.50 at 304.80. That 2024 December wheat crop down 14 cents at 5.58. July for 2025 wheat down 12 cents at 5.97. And then cotton for December of 2024 down 1.84 cents per pound at 70.36. Cotton for December of 2025 down 0.77 cents at 72.72. And then that West Texas Intermediate Crude Oil contract down $2.55 a barrel at 67.45. So, Ben, a lot of flat movement, or really, I say flat movement, that indicates not much movement, but we had a move higher than a move lower that totaled into about a flat change. So, what's your look at the market as we move forward?
I think to me, one of the interesting ones here is in that West Texas Intermediate crude oil for December. We have some support in the crude oil market right around $65 a barrel. We've moved lower on just growing stocks and kind of weak expectations of demand in the global market. And so, it makes sense to me that we're going to go down and at least test that $65 per barrel mark. And we're only $2.45 away from that, and we had a $2.55 move per barrel this last week. So, not to say that it's going to take a whole lot to get there, but it just seems like we might go down and touch those levels for a period.
So, Ben, help me understand, I guess, the picture on the crude oil front. We're producing at a record pace right now. We just set a record for October last month or this past month. So Why is production ramping up at this point in the year? Oftentimes when I think of crude oil, I think about the summer driving season. Does this have some interplay maybe with the election cycle, or what are the factors that might adjust the crude oil production at this point in the year?
Well, sure. So part of this is the U.S. is a large producer of crude oil. In fact, we're the largest producer. I think this is our sixth and maybe even seventh year of being the largest crude oil producer in the world. We produce a lot. We talk a lot about the OPEC countries. Part of the reason why we have such a fascination with the OPEC countries is because they kind of operate as a coalition that in a lot of market-based economies isn't allowed, but for some reason it's allowed, and that's a whole different podcast. But for some reason, this coalition's allowed to exist in global crude oil production. And so, those countries have kind of bound together to say we want to support prices of oil by cutting their production. And so they have voluntary production cuts in place to help lower the output and to help support crude oil prices, given the expectation of weak Chinese and global demand for economic activity and diesel fuel or oil. But the United States is kind of operating in a different sphere of that. Like, we're seeing that, hey, the global production's kind of scaling back a little bit. The market incentives are for U.S. producers to continue to produce. And here for the month of September and October, I know we're getting close to the end of October, but we've basically been running at all-time volumes here for the last 4 weeks in terms of crude oil production. And so, that's just helping stocks grow, I think, here in the United States. It's also increasing our export portfolio. So, we're sending more crude oil into the export market as well. And, it certainly looks like 2024 is going to be an all-time record for crude oil production. Right now, we're sitting about 7.5%, 7%, 7.2, but 7.5%, 7% above the record that was set in 2023. So, large story straight
Big
is the
jump.
incentives. Yeah, so the incentives are there for U.S. producers to continue to produce oil, and they have been for pretty much the whole year, but especially here the last 4 weeks.
Well, Ben, looking at how that impacts the ag sector, obviously the cost side, but looking at the production side, as a mentor of mine says that a rising tide carries all boats. And we've seen ethanol production spike up, and we've seen strong ethanol production. But one of the things that you've noted is that the profitability hasn't really been shifted too much here recently, but that could start to change here somewhat soon, and profitability might be dropping. So do we see maybe a step down from this heightened ethanol production that we've seen here as of late?
Well, yeah, so you raise a great point. We've been running roughly 3% ahead of ethanol production here in 24, 25 compared to what we did a year ago for the 23, 24 marketing year. And the expectation is not that high of ethanol growth year over year. It's flat, but if we were to see this continue 2.5%, 2%, ahead of pace, that would amount to 100, 150 million more bushels of corn use. That would continue to shrink our ending stocks. And so, very similar to this summer, ethanol demand, corn demand from ethanol is really kind of been a bright spot in our demand picture. It's one of those things that it rarely surprises to the upside, but it is running a little bit stronger now compared to where the expectations of it are. The reason I say that I think profitability is starting to weaken and that we could see a slowdown in production is we are seeing a little bit of a deterioration in ethanol prices. So a gallon of ethanol, we're seeing some deterioration in that market from the standpoint that we are starting to get into the period where people aren't driving as much. The winter tends to be a little bit smaller of a driving season. Of course, we have the holidays that kind of create some weekly outliers and different things like that. But we are starting to see a little bit of slowdown in that area. Ethanol stocks continue to remain fairly large. And when I say fairly large, we are running above what historical volumes of ethanol in stocks would suggest. And the hope is that we can export some of those ethanol stocks too to help support that market. But right now, kind of a double pinch on ethanol production, a little bit of a deterioration in ethanol prices, and the expectation is maybe to continue for here a couple more weeks. And at the same time, we've seen a little bit of a rise in corn prices here over the last couple of weeks as well.
Don't say that too loudly, Ben. Uh,
I know we
look,
were flat. I mean, we were only a 1% change week over week in corn
yeah.
market, but it wasn't. But three weeks ago, we were about 25 cents lower in the corn market than where we are today. So, corn prices have rose about the same time the ethanol prices have started to decline. As a result, we're well below our break even, or I shouldn't say our break evens. We're well below the returns for a gallon of ethanol that we've been experiencing this summer.
Well, Ben, looking elsewhere, we've seen some progress on the export front, and coming out of the last marketing year where it was very slow for a lot of for long periods of time, we're seeing some things pick up now around harvest here in the U.S. We're seeing increased exports to countries like Mexico, Japan, South Korea, and others. On the soybean front, we're seeing some increases up from week over week into China and Mexico. Ben, what's your ultimate picture looking at the export front? How sustainable do you think these increases in export numbers are?
Yeah, so you're right. So like let's take corn for instance here. When we look at where we're at today compared to where we were, last year, we're leaps and bounds ahead. We started off about 26% slow last year. Now given the week, whichever week, we're 15 to 20% ahead of where we were last year. So the corn export picture has been very strong. It's not as strong on the soybean side, although we have been seeing some kind of consistent sales that are allowing us to kind of shrink that deficit that we built in the soybean market. We're going to need more on the soybean side, is how I want to phrase that. On the corn side, let me just here for just a couple of seconds talk a little bit about what is unique about this corn cycle. So this is the third largest book of sales that we've seen in the corn market. It's third only to 2020 and 2021, or those two marketing years when we saw China buy a lot of a lot of corn during that period. What's interesting is this go around, it's not China, it's Mexico. Mexico continues to buy lots of corn. I've been asked here in the recent weeks why Mexico's buying so much corn all of a sudden. And I've been accused of not answering the question. Let me step back here for just a second, right? So like we expected Mexico to buy a lot of corn this year. I've been pretty transparent for months now that I thought Mexico was going to buy a lot of corn from the United States because they needed corn and we had lots of corn to ship. The timing part is a little bit more curious. They tend to come in and buy a lot of corn all at once. Sometimes it's in the spring, sometimes it's in the fall. Maybe it's one or two, or maybe it's split up between one or two sales. There is a buzz that Mexico's front loading right now, just in case things change in the political sphere. I sit here and say, this is what we needed. This is what we expected. So from that standpoint, it's not surprising. The timing is curious, right? Like I can't answer the question if they're front loading or not. We just have corn. It's at a reasonable price. They need corn, and I'm glad they're buying. So that's kind of my
That's
answer.
the picture there.
Yeah,
Yeah.
I don't think that still answers the question of why they're buying now. All I can say is I expected them to be a big buyer this year. They've so far been a big buyer in 2024, 2025, and it'd be really nice if they came in and bought more this spring. So
Yeah, and then giving just the briefest of snapshots internationally, looking around the globe here, Argentinian corn production is seemingly to drop just a little bit on some differing factors. And then meanwhile, Vietnam and Colombia are looking to increase feed grain imports, corn imports just slightly. Ben, I'm gonna put you on the clock for about 30 seconds. How much of an adjustment or opportunity does this give the U.S.?
oh, this is what we've been talking about, right? Like in some ways I've said that, everything on the corn demand side is plugging away strong, right? Like feed demand is going to improve. Ethanol has been strong and it's maintaining. The big growth potential was on the export market, and I think we're seeing it, and we're seeing it kind of unfold. The question I'm getting is, well, why aren't corn prices riling higher if we're getting all this demand? And I just want to remind folks how big of a corn crop we have between last year's stocks that were held over and how much corn we produce this year. We have lots of corn that's going to allow us to increase demand, and unfortunately, we need that. I guess my counter is, if we didn't have this increased demand or this expected demand that we thought we were going to get in the export market, prices for corn would be a lot lower than where they are today. So.
All right, Ben. Well, looking forward into the rest of the week, what should farmers and ranchers be paying attention to that could move the markets?
Yeah, so after a couple of kind of relatively quiet weeks, we start picking back up here as we turn the month to November. So this coming Friday, November 1st, is when we're going to get a lot of our beginning of the month reports. So grain crushing, flour milling, cotton systems, fats and oilseed reports, those all come out to give us an indication of demand for the respective commodities. We also get a slew of economic data. So consumer personal expenditures, U.S. employment and hourly wage reports. Those have been really strong gauges for future inflation. So those come out on Friday as well. The rest of the week, some other things. And then, of course, first notice day. I skipped over first notice day for November soybeans on Thursday. I think we start drifting into, kind of drifting into lower prices here for a couple of days leading into that first notice day in November.
All right, very good. Well, viewers and listeners, if you'd like to learn more about us and what we do, or our sister program, the weekly livestock market update, you can check us out at brownfieldagnews.com. Ben, it's always a pleasure having you on here. Thanks again. I'm Will Robinson on Brownfield.